This is and we're live. Here we are. Welcome to the final edition of our entrepreneur education session for this fall. Really happy to have a special guest here, Kambez from KRP, a longtime sponsor and friend of Startup TNT. KRP does my accounting, and my taxes are actually a little complicated because I am American. And so I really love working with KRP, and I'm really excited to dive into what your financial statements say about you. A little bit of a different topic. I don't think we've really dug deep into this. And I was just telling Kambez, back when I was an MBA student, we did a really fun exercise like this. We all got to look at a financial statement and trying to understand what it implied about what was happening in the business. So I think this is going to be a really insightful session. How are you feeling, Kambez?
I feel good. I'm happy to be here. So thank you for the
great. You're looking sharp. Kambez, where are you based?
Edmonton, Alberta.
And how did you get involved in accounting and KRP?
That's a good question. I always had a knack for numbers, and I knew I was going to take some sort of a path, whether it was engineering or accounting related or finance. And then a good friend of mine was working in accounting and kind of showed me the way, so to speak. I'd taken a liking to it, and then I started articling with KRP actually about 10 years ago, over 10 years ago now. And then I just progressed through the ranks and stayed with the firm and really enjoyed my time here.
And do you sometimes equate being an accountant to being like a detective? Like you're like looking for something odd or missing? Is that a good analogy?
Sometimes, yeah. So when it comes to an audit, our lens changes a little bit and we look at it from a risk perspective. So we look for things that maybe are not necessarily in the financial statements, whether it's a large liability or something that's missing. So you do become a bit more forensic, I guess, in that sense. And there's a component to it where we're kind of solving puzzles along the way because we identify a problem and then we try and work backwards to figure out a solution.
Awesome. Okay. Well, listen, I just want to remind the audience, encourage people to put questions and comments in the chat as we go. We're going to dig into an actual financial statement of a publicly traded company. And so we can all kind of work together to figure out what the implications are. But before we do that, I just want to make sure we understand kind of a little bit about what you guys do at KRP. And so why don't we just start with that? What's like a quick overview? What's kind of like your day-to-day life look like at KRP? What kind of services you're doing?
Yeah, that's a good question. So we are a full service-based firm. So we do everything from personal taxation to corporate taxation to preparing financial statements to then completing assurance engagements, whether they're reviews and audits that we're kind of going to go a bit more in depth into later on. So basically one-stop shop for everything related to that sort of avenue of things. And then the other part of it is where we really try and pride ourselves is we go beyond just the compliance work. So I know you have to file a tax return because the government says you need to do it. But then the advisory component is where we really come in and add value. We help explain some of the more complicated items. We look at financial statements and provide advice on maybe strategic decisions on where the company should go, how they should reorganize their structure, what does their debt look like, what are their financial statements really saying about the company in the year that they just had. And that's really predominantly where majority of our time is spent. A typical engagement may take a few weeks to turn around, but once that is completed, we have a very in-depth conversation with the owners and management. And I think that's really the meeting that everyone is looking forward to when they're dealing with Kingston Ross Pasnak.
Awesome. Well, you know what? Let's kick off this conversation with like a very high level question, which is why does good financial reporting matter, Kambez?
Yeah, that's a good question. So again, it depends, I guess, from which lens you're looking at it. But if you're looking at it from the owner's or management's perspective, good financial data gives you ability to strategize and plan for the future and have reliable information at your fingertips that you can then use to make these strategic decisions. If your financial data is not reliable, it doesn't give you a good picture of what's actually going on and has transpired within your organization. So you may be looking at a number in your financial statements and you may be reporting a net profit, but your cash is negative. The numbers may not be accurate. Then you really can't make informative decisions as far as, well, do we need to expand now somewhere else? Do we need to hire more people? Do we need to purchase more inventory? If the data is not reliable, your decision-making becomes becomes poor or impaired.
And I think it's relatively common, to be honest, for startups to have somewhat complicated accounting, like in terms of recognizing revenue, selling a service that gets delivered over the course of the next 12 months, but you collect cash up front. How do you account for all of that, using best accounting principles? Let's talk about sort of that 3 levels of financial reporting review that you guys offer, starting with that audit level, because I know this people, we all hear this, these are my audited financial statements. What does that mean? And walk us through what the audit actually is.
Okay, so audited financial statements will be the highest level of assurance that you can get on your financial statements. What happens with an audit is an independent third-party accounting firm like KRP would come in and look at your financial data and then provide an audit report with our signature saying there's nothing overall that seems that is materially misstated in these financial statements based on the audit procedures that we have completed. The audit goes fairly in-depth in the financial data, so having good financial records, controls in place, and procedures becomes very important, because the company actually needs to be auditable in order to go through an audit from the start to finish. So an audit will actually involve a lot more elements compared to the other 2 reportings that we will talk about. With the highest level of assurance, we're looking at things like inquiry will be done, analytical procedures will be done, recalculation of your balances, we'll be asking for support of your balance sheet amounts. We may bring in outside experts to help us in certain areas of your financial statements that may become too complicated. And then we may actually do a step-by-step test, which we call substantive testing, basically from cradle to grave of a transaction, to make sure that everything that you're saying you're doing in your organization is done correctly without errors, and it's then reported in your financial statements. Hope that kind of...
Okay. I think the statements you're sharing are audited, so I think there might be some information there about some of the stuff they did. I looked at these ahead of time. Okay, quick confirmation, or just quick question: is the auditing firm always arm's length? You can't use your own accounting firm to audit. Does it always have to be an outside firm?
That's correct. It has to be an outside firm because there is a factor of independence involved and objectivity. So you have to have that firewall in between. And then a couple other items I maybe forgot to mention on the audit financial statements is you actually do have a handbook that a CPA would have to follow, depending on which framework your financials are reporting under. The common ones are, international financial reporting standards, which most public organizations in Canada report under, or accounting standards for private enterprises, ASPE for short. And those are typically designed for private organizations that don't want to go into the complexity of the IFRS standard, because they may have limited number of users that actually use the financial statements. It might just be the owners and the bank, as opposed to a public company, which actually has a large number of outside investors that will be looking at those financial statements. Audited financial statements not only come with the statements that we're familiar with, which is the balance sheet, income statement, cash flow, but actually does come with extensive number of footnotes that then provide further detail on the policies that were used in order to prepare the financial statements, and the breakdown of the large kind of the line items that you're seeing on the statements, what they're made up of, and what kind of transpired in the last 12 months. And again, that's all in accordance with the handbook, because it gives you a roadmap on what you can and basically can't disclose in the financial statement notes.
So who's doing which types of companies are auditing their financials every single year? Because we know it's expensive. It's a lot of work. It's expensive. Not everybody wants to do it.
Right. So typically, it depends on the number of users involved and the number of investors. So if a company has a lot of shareholders involved in an organization, maybe many of the shareholders are, call them offhand shareholders, but they're not necessarily in the day-to-day operations and they're not actually working inside the company. They may prefer to have audited financial statements because a third party now comes in and provides an independent opinion on those statements. So in those circumstances, even if it's a private company, you would see people wanting audited financial statements. The other more common instance where we see audit financial statements being requested is the lenders and those providing credit facilities to the organization. They want to make sure that they get a copy of audit financial statements because they rely on that data to then run various financial ratios and covenants to make sure that the company is a going concern and is able to then pay down the debt that was extended to this organization. I know you guys have talked about, I think, banking and lending in other presentations, but depending on the amount of credit facility that has been extended, again, the amount of total debt, and depending on the type of banks that you're dealing with, they will ask you for specific reporting requirements. They may ask for a review, or they may ask for a full-blown audited financial statements.
Okay, great. Well, Ruth's asking an important question here, which is, do investors ask for audited financial statements? And generally, angel investors investing in these early stages do not. I think I mentioned this to Kambez earlier. I'm actually only aware of one company that we're invested in at TNT. There might be more, but there's one that I know for sure that actually does audited financials every single year. And I think, Kambez, you mentioned that if you want to go public, you need 3 years of audited financial statements. Isn't that correct?
Yeah, as part of your prospectus, when you apply to an exchange, they will require audited financial statements because the data needs to be reliant, since you're opening up yourself now to the public. In many startups, again, depending on the size of the startup and the number of people involved, you may not need an audited financial statement because, again, it goes back to the conversation we had about increased cost, because now you're bringing in professionals who are spending a lot of time looking at your data. Costs that may, as a particular startup, may not necessarily want to incur during their growth phase, and they may want to actually deploy that cash and redeploy it back in the company, and rather grow the business as opposed to having that professional, reliable data that's being audited.
Yeah. I think Ruth's asking a sort of follow-up question here, Kambez. So I think I actually don't know the direct answer, but I suspect it might have to do with that IPO situation where this company is looking at, do they want to IPO on one, like a venture exchange or a smaller exchange relatively soon, and they just want to be ready for it. I think that might be their explanation. This company is a little bit bigger than most of the startups in our portfolio. They have a decent revenue. So like this, I kind of want to move this direction towards, like, audits are probably something most people on the call aren't going to do immediately. They're going to go with probably one of the cheaper options. So wait, hold on. Let's take Stan's question first. Yeah, cost. There we go. I was going to ask this question as a follow-up. Auditing is expensive, and I know it can range based on the size of the organization, but what type of order of magnitude number are we thinking when we're thinking audit to audit my financials?
Yeah, again, that question, it's a loaded question because the answer is always depends. It depends on the size of the organization. It depends how clean the accounting records are. It depends what industry the company is involved in, right? So companies that are involved in, let's say, life sciences, which is more cannabis related, or digital currency, which we're seeing more and more, that would be your crypto assets and NFTs and stuff like that. It requires a certain level of specialization. So the audit fees are automatically substantially higher versus maybe your traditional mom and pop shop selling widgets down the street. So again, that range of auditing fees can be very, very substantial. It could be, maybe on the lower level, a small audit could be about $20,000, let's say, and I'm just kind of spitballing numbers. And then large audits can be close to a mortgage, depending on the size of the organization, right?
Well, so okay, let's talk about some of the other options, Kambez. So what's a lower level version of an audit?
Yeah, so again, we kind of talk about the three main reporting options, audit being, again, the top level that you can get. The middle tier would be what we call a review engagement report. Now, a review provides limited assurance. Okay, it's stated right on the report. And the commentary on that report would be is that these financial statements are not likely materially misstated. Now, the amount of work that goes into a review is substantially scaled down compared to an audit. You will not be necessarily looking at doing substantive testing, testing that we talked about, going from kind of cradle to grave, start to finish. That sort of stuff is not necessarily involved. Although with that being said, if there is risk within certain areas of a review engagement, you may want to introduce specific audit procedures, but they're not necessarily required. Now, a review engagement really consists of inquiry and analytical procedures. And you kind of compare the 2 years, figure out any main variances, you ask for support on the balance sheet items. And then that's kind of the scope of the engagement involvement. With that being said, a review also follows, the handbook, and it will have your full set of financial statements and footnotes. So you're still getting a pretty detailed level of financial statement reporting, just not to the scale of an audited financial statement. And then kind of tying the review back to our previous question of like, well, who would want to get a review statement? Again, that would be entities involved, organizations that don't necessarily need a full audit, but they do want some sort of assurance on their financial statements. And a lot of times the banks, depending on the credit limit that they provide, will usually ask for a review engagement. And the reason they do that is because, again, they want a third-party independent party come in and give an opinion. At the same time, they're conscious of the cost of an audit engagement, so they will just settle for a review because they can still get that limited assurance over the data that's being presented to them at the end of the year.
Can a review sometimes lead to the accountant saying, there's some irregularities here, there's some odd things in here, I would suggest an audit to figure out what's going on? Does that ever happen?
No, because you are able to qualify your report on the review. So you could, say that I'm unable to give a clean opinion on this review because of XYZ. It's just too messy, or the processes are just not in place. I can't comfortably say that this, let's say, cost of sales number, which then flows into your net income, which flows into your retained earnings. I can't comfortably say that this is accurate based on the discussions we had. It sounds like the client's not recording it correctly. So we're just going to go ahead and qualify this opinion and say that, here's the opinion, but here's the caveat that it may not be done correctly.
Right. For the banker, I'm guessing they don't need to do the full audit. They're just like, that's enough to be like, let's move on. Let's fix all those problems and then we'll talk again. Exactly.
Yeah.
Okay. Let's talk briefly about kind of the basic level compilation that you mentioned. Working, what does that look like, and when are we using just like the base level compilation of financial statements?
Yeah, so a base level of compilation is no assurance being provided on that particular engagement. And a lot of the times what we're seeing is compiled financial statements are basically, we take the data from the client, we put it together into nice financial statements. These financial statements will not have a cash flow and they will not have footnotes. And for the most part, your accountant will just make sure that nothing really blatantly pops out as being incorrect, because these financial statements are really done more so for compliance purposes in order to file a tax return. Okay. So recently, they used to be called notice to readers, but now they're called compilations. So they do have a standard now that, we need to adhere to. There is a report that says, these are compiled financial statements, and it talks about the limitations of it. And then that is basically the lowest level of reporting that you can kind of get. And again, you are getting somebody else to help you compile these statements, put them in a nice format that people are used to. And a lot of even banks, depending again on the amount of credit that you're getting, will accept just compiled financial statements, and they will ask for them in their loan agreements in order to see what the data looks like.
Are you able to share any general, how much should entrepreneurs be budgeting for compilations? Is that can you share?
Yeah, again, there is a range depending on how clean the records are, how complicated it is, the number of transactions and so forth. And, whether the entrepreneur is doing the accounting records and tracking themselves, or are they just providing, a banker's box full of receipts to their accountant? So that will obviously have an impact on the amount of time that it'll take to prepare it. But a typical engagement will range anywhere from $2,000 and up. And that typically includes, the compiled financial statements and the Canadian tax return filing for both federal and provincial purposes. Yeah.
That's pretty good. I think my personal taxes cost about that much to comply with the U.S. complicated matters. So that's not bad.
Perfect.
Okay. I think we're ready to dig in. I want to dig into an actual financial statement. Let's start peeking under the hood and seeing what the financial statements say about Converge Tech. You ready, Kambez?
I am ready. Okay.
Let's do it.
So I will just share my screen. Okay. Are you able to see my screen?
Yeah, it's looking sharp.
Perfect. Okay. So, one of the exercises that we discussed is just looking at a publicly traded company. And we're going to look at it at a fairly high level and talk about their statements. We won't necessarily go in depth into any of the notes, but we'll try and use the numerical data as a way to tell a story of what we think happened with Converge, during their December 31st, 2021 period. And again, I didn't necessarily read the MD&As or the news releases. I don't audit this entity, and nor any of the conversation that I'm providing here is investing advice by any means. So this is just a high-level overview of a random company that we picked. Okay, so at the start, we can see that, this is kind of the title page. It tells us what the company name is. And then instantly we see that it says consolidated financial statements. So that tells us right away that this is probably a parent company with subsidiaries that have been integrated into these statements. So these statements are a combination of a number of entities. And then it tells us that, we're looking at December 31st, 2021 and 2020. So that is the period that's being discussed right now. And, a lot of the time when we are dealing with financial statements, it's typically on a historical basis. So we're always looking back at the stuff that happened and we clean that data up in order to prepare those statements for the future. Moving forward, we can see that an independent audit report has been provided with an opinion attached for the years that we were just discussing. And the important thing to note on the report is that this particular financial statement is actually under International Financial Reporting Standards. So it's under IFRS. So that is the general handbook that they used, and everything here abides to it. The opinion given here is clean, so nothing major has popped up. They did identify a couple of key audit matters. So discussion over goodwill impairment that we can kind of talk about when we get to the balance sheet. There's a lot of sensitivity revolved around impairment and the analysis of it.
What can you define for us what that means, impairment?
Yeah, so impairment would be basically, has any event occurred to kind of give you a feel that the asset value that you're showing on your balance sheet is no longer at the value that's being shown? Is there anything to suggest that maybe the value has become impaired and it needs to be written down? Okay, so a common example, if we talk about goodwill. So goodwill is typically acquired through a business combination. So if one company, parent company, purchases a subsidiary company, what they do is they will bring in all of the assets and liabilities at fair value into their statements. And then you compare the fair value of the assets and liabilities to the total price that you actually paid to acquire that entity. If the price that you paid exceeds the value of the assets that you've acquired, the residual falls into goodwill. And basically what you're saying is that you have overpaid for this company because there's an embedded value to which you can't attach a price or a specific asset to, right? So it could be the company's reputation, because the company's been around for so long and so forth. That is the goodwill that you just basically inherited. Impairment of goodwill in this particular discussion would be, does something suggest that goodwill that you have capitalized on your balance sheet may be overstated? And that could be that, originally when you purchased the company, you were expecting that it was going to generate, let's say $100,000 every year in net income going forward. But something has transpired and now the company is reporting losses, or it's just not able to meet that $100,000 that you had originally set out in your mind when you purchased the company. That event suggests that your goodwill may have become impaired. So you need to reassess your goodwill and potentially write it down, because the company is no longer worth what you originally thought it was worth to you.
Yeah. Okay. And then this negatively impacts your balance sheet. You have less
That's
assets.
correct. That's correct. Yeah. So you're effectively writing down an asset and thinning out your balance sheet.
Okay. Awesome. Thanks, Kambez.
For sure. Okay. So that is basically the audit report. It becomes dated and signed by the auditor. And we can see that, Ernst & Young has signed this report on March 22nd, 2022, when the audit got completed. Now, the first statement that we're going to come to is going to be the statement of financial position, or, another way to call it is a balance sheet. Now, before I dig into the balance sheet, I just want to take you to the very first footnote that becomes fairly important. We want to, anytime we're doing an analysis, and let's say we're looking at it as an investor, from an investor standpoint, we want to understand what the company does and the industry that the company is involved in. So here, the first note typically describes exactly that. So it tells us that Converge is a hybrid IT solution provider with operations in North America and Europe. So instantly we know that they're operating in more than just one area. So we may have foreign exchange involved within these financial statements. These financial statements clearly tell us that these are expressed in Canadian dollars. So that becomes, again, an important factor. If they're dealing in USD and, let's say, Euro, there's going to be a conversion factor involved. So this company is focused on delivering advanced analytics, cloud, cybersecurity, managed services, etc. On February 9, 2021, the company announced that it has received final approval from the TSX to graduate from their venture exchange. That probably tells us that now the company is able to access a larger market during the year, which actually provides them with additional capital that they can get by sending out their common shares from their treasury and selling them probably at a higher rate, at a higher price, because they're now part of a larger market, because they're part of a TSX. And then the final item I'd probably highlight is, again, when we talked about this company being consolidated, we can see that it actually does list off a number of subsidiaries that are involved in these financial statements. All right. So back to the statement of financial position. So it tells us that it's in Canadian dollars, and then it also tells us that all the numbers here are expressed in thousands. So really, we're talking about 248 million. But just for simplicity's sake, I'll say thousands as I'm going through the analysis of the statements. Okay, so what I'll do is I'll probably go through the balance sheet for the most part, line by line, and then income statement and cash flow, we'll probably pick and choose the lines that we want to talk about. And that'll pretty much give us a pretty good overall image of what happened to the organization. So let's start with cash. So cash is king. We all know what cash is. We can see that the cash increased from 64,000 to 248,000. Instantly, that tells us that the company probably had a good year and it was able to ramp up its cash and actually save some cash at the end of the year in their bank account. And then we'll see if our assumptions kind of align with what's going on in the financial statements as we go. Trade and other receivables. So we see that accounts receivable increased to 416,000. Now that is always a matter of timing. And at this year end, you can see that they had not collected in cash about $416,000, but they're expecting to collect that subsequent to the year end. The more cash that's being tied up in receivables, the more it becomes challenging for an organization to have liquidity, because it's relying on their collections of receivables in order to have that cash to facilitate its working capital. Now, many banks will actually provide you with lending that is tied to receivables and inventory. They will provide lending that's tied to, let's say, 75% of good receivables, which effectively means current receivables. They don't want to necessarily provide you lending for receivables that have been outstanding for 90 plus days, because there's a concern that you may not be able to actually collect it. We can see that inventory has increased from 37,000 to 104,000. Banks will typically, again, finance that around 50%. It's not an item that's necessarily loved, because inventory has the ability to become obsolete pretty quickly, especially in a company like this when we're talking about IT, computers, hardware, and software. We know how quickly technology changes. And if you're not able to sell certain computer hardware, it may become obsolete. Now, inventory is typically, in this company too, is valued at lesser of cost or net realizable value. And what that means is cost would be what you purchased that inventory for. Net realizable value would be what you expect to sell it for. So if down the line you expect to sell it for less than you actually purchased the original inventory for, it ties back to that impairment discussion we had, and you're going to have to write down the inventory to net realizable value. And the last item we have is basically prepaid expenses. So just expenses that they had paid in advance, bringing on current assets to about 780,000. And we see that last year, current assets were about 477,000. Now, current assets become an important line in the financial statements, because typically lenders like to see a large value of current assets because it's tied to liquidity. If we look at what we call a working capital ratio, we can see that last year, current assets were about 477,000. Current liabilities were 571,000. That tells us that if current liabilities were called, all of them were called at once, let's say, this company would not have enough liquidity last year to be able to pay down all of the current liabilities that were due, because they only had 477, whereas the liabilities are actually 571. So there was a shortage. So their working capital was negative. Now, in contrast to this year, we can see that their current assets increased to 780,000 and their current liabilities are 591. So what they had done this year is they've improved their working capital. if they improve their working capital ratio, and in theory, they become more liquid. And obviously, that's a combination of cash going up, some AR, and inventory. Now, moving down, we see that property, plant, and equipment and right-of-use assets are about $30,000. And the number seems fairly small relative to the other assets that are on the books. Now, that probably aligns with our expectation because this company is not necessarily CapEx heavy. They're not relying on heavy machinery, heavy equipment to make their money. A lot of their earnings are based on services that they're providing and obviously selling some inventory. So their CapEx that they're using is probably relatively small. And we see that the change from 23 to 30 implies that they may have purchased some additions this year, but not a substantial amount using cash. The next line item is intangible assets. Okay, so intangibles increased from 108 to 233. So that could be for a couple of reasons. One is, let me kind of skip to the goodwill line. So goodwill went from 110 to 323. That increase right there probably tells me that they have acquired a number of businesses throughout the year. And clearly businesses that they feel have added value because they have overpaid for what they expect the assets to be. So they may have done a number of business acquisitions. As part of those acquisitions, those businesses probably had things that were intangible assets that they could actually attach a value to. So intangible assets in this case could be things like customer relations and trademarks, or even patents that clearly have a value because you can calculate potential cash that particular patent, let's say, could generate over time. So intangible assets, goodwill, both going up. When we look at the cash flow statement, I would imagine that we will see a big cash outflow for acquisition of businesses. So we'll see if our expectation agrees to that when we get to the cash flow. And then there's some minor non-current assets. So that brings total assets to about $1.3 million.
Hey, Kambez, any quick reaction is this a good balance between current and long-term assets in terms of the asset mix? Like, is this typical or is this heavy? Like, it looks like almost an even balance based on those numbers there. But any thoughts on that?
Yeah, good question. So
cash as a percentage of total assets, things like that. Go ahead.
Yeah, and so the various metrics and financial ratios that investors or even bankers apply to financial statements will vary based on industry and based on the company's trajectory in its business lifespan. So a company that's been around for say 1 or 2, 3 years would have a different set of expectations than the company that's fully mature and been around for 10 years. Looking at these statements, I would say that last year it was concerning the fact that the current liabilities were lower than, or current assets were lower than current liabilities. What would make me happy as an investor, seeing that they have improved that ratio this year. Now, if we compare total assets of $720,000 that they had last year to their total liabilities of $618, again, the numbers are fairly close. I wouldn't love that. I wouldn't love to see that. What it suggests to me is that the balance sheet is not necessarily that strong, and it's going to need some time to accumulate more assets and maybe become a stronger balance sheet. Now, fast forward to this year, we can see that the current assets of 1.3 million to their current liabilities of only 720. So liabilities stayed somewhat consistent. They increased because operations increased, but there was a large increase in the total assets, likely related to the acquisition of the number of businesses that they have. So the 2021 balance sheet looks substantially stronger. As far as specific metrics, again, it kind of varies, but the rule of thumb would be you might want to see your current assets to be about 1.25 times your current liabilities. And again, that number will kind of move throughout the year, and depending on how management decides to utilize their capital, they may not necessarily want to maintain that ratio. They may see an opportunity to acquire a business in their industry to make them better, even though it may hurt their cash. They may go ahead and just do it. So,
Kambez, there was a question from the audience about goodwill, and you touched on this briefly, but maybe just a little more, if you can elaborate any further on how does one go about calculating goodwill, and is there any details in this document on how they calculate it in this particular case?
Yeah, so if we go into the footnotes and kind of read them in detail, and in this case would be footnote number 8, it would probably provide us with a lot of detail on which companies got acquired, what their numbers look like, and really what goodwill is made up of this year, basically to facilitate the change. When it comes to business acquisitions in these sort of financial statements, there is reliance being placed on external experts. So for our firm, for instance, we would utilize our KRP valuation team, and their sole purpose is to look at the purchase price acquisition of businesses to make sure that the valuation that's being given to a business is reasonable, right? Because if let's say an outsider has not looked at this, you could just inflate goodwill and really say that, there's substantial value to everything we're buying. However, when you bring in experts like ours, we do go through the valuation process. We actually come up with a more robust way of telling what the fair value of the assets are that are being acquired, what the residual goodwill is, et cetera, or whether there even is goodwill, right? Because you may think that you're buying something, but then an outsider comes in, like us, an independent valuator, and they may say, no, look, you overstated what you think this business is worth, and we got to write that down.
Yeah. I'll also point out to everybody that at the very beginning of this document, the auditors actually had like a little table there, and they listed off like 6 or 10 bullets about kind of the different tests they did to try and validate what the company had done to value their goodwill, and they ran through a bunch of the things, some of which you discussed there. So can be insight with those things if you're interested. Okay, cool. Let's keep going.
Yeah, and then just one minor note is, when it comes to doing that sort of work, it does become challenging because what you're doing is you're auditing somebody else's judgments and estimates with your own judgments and estimates using the most reasonable data that you can find. And then you compare the two and do a sensitivity analysis to figure out, is this within the ballpark of what it should be? So and that's probably why it's a key audit matter that they pointed out, is because there's substantial judgment involved in that particular analysis. Okay. So moving down to liabilities. Last year balance is about 398. This year, the liabilities increased to 519, probably due to increased operations and just at year end, they haven't had a chance to settle all of the amounts that they're owing. But if we look at the bottom number of borrowings, we can see that the two numbers last year ended up being about 533,000. So this year, it seems somewhat comparative. Their accounts payable increased, but they were able to pay down their borrowings. And then if we look at the long-term portion of the borrowings, we can kind of see the same thing, is that they were able to pay down that amount. So I would imagine on the cash flow statement, if they were able to generate a bunch of cash this year, they probably utilize majority of it to settle the debt because they want to get rid of that debt on their balance sheet. And that's how they utilize their capital, and probably management made that decision on where the capital should go. They have a line for other financial liabilities, which seems to be fairly comparative to last year. Their financial liabilities are made up of right of use liability, notes payable, and an earnout. Now, right of use assets and right of use liability is a fairly new concept in IFRS 16. Really what it is it's any lease that falls within the criteria of being able to be capitalized, they record the asset and then they record the related liability on the balance sheet. And then as time goes on and that lease is being paid down, the liability will go down and the asset will get amortized down as well. So there's a liability component included here related to that right of use asset. So it's just a capital lease basically.
Okay.
Yeah. I got a bit more detail here, but I'm trying to keep it somewhat high level. I don't want to get too in the trenches. Deferred revenue, and this is a liability line. Really what that number is comprised of is customer deposits. So Zach, that kind of goes back to what you were talking about, where a customer may prepay for a certain service or a product, but that service actually is rendered over a number of years. So let's say a customer put down the deposit for a IT service for the next 3 years. It would not make sense for the company to recognize the full balance as revenue. Rather, what they would need to do is they would have to defer the cash that they received as a liability because they have not earned that cash yet. And then over the next 3 years, they would bring it into their income statement as the term of that particular arrangement expires. So at the end of 3 years, the full amount would have been brought into their net income statement or profit and loss statement.
Okay,
And that's
I want to ask a quick question about this liability, about the liabilities, and then there's another question from the group. People love talking about goodwill, so I hope you've got some more time for that. What about the ratio of the current liabilities to the long-term liabilities? Like if I look at this, the current liabilities are 591 for this year, and the total liabilities are 720. So like the current liabilities are like the lion's share of the total liabilities. So like, is that a cause for concern? Is that good? Is that bad? Or does that not matter that much?
It can be. So I guess what that really tells you is if your current liability is substantially longer than your long-term liability, really what it tells you is that a lot of your obligations are probably going to be due within the next 12 months, right? So the lion's share of your overall debt is going to come up within the next 12 months. So one way or another, the company needs to prepare to settle that overall debt. So they will need to eventually pay this 519,000 of trade and other payables. These borrowings will have to go down, et cetera, and all of this debt is current. Long-term would be any debt that's outside of that 12-month window. And as you can see, that number is actually substantially lower. So once they get through that next 12-month window, their debt overall goes down. But again, as the company grows, they're probably going to acquire more debt, and these numbers will continually end up changing, right? Their payables will probably go up next year and so forth. Now, analysis of current liabilities versus overall liabilities. Typically, I haven't really seen that analysis because I think what you would want to be more concerned about is what are your assets relative to your liabilities, and what are your current assets relative to your current liabilities in order to actually be able to repay that when the time comes.
That makes sense.
There are other ratios that entrepreneurs and investors may be looking at. One of them would be, a quick ratio. So that would be similar to the working capital where we're looking at current assets and current liabilities, but sometimes you back out things that you feel are not as liquid. So that would be, prepaid expenses can get backed out, or sometimes even inventory can get backed out, and see if the residual amount without those two main components is still in excess of your liabilities, right? Because prepaid is not something you can transfer into cash if time came in order to settle this debt. So that may be something you would normalize for and take that out because it's not really a liquid asset for you. So then really all you're left is with these three components. Here, it's not a big deal because we can see prepaids are fairly small, but in other companies where, let's say they made substantial prepaid deposits, it can become a big factor. And then I guess the other common ratio that folks typically look at is debt to equity ratio. So you just want to see what is your total debt that you have in the year. So in this case, 720,000 relative to the equity balance of 648, right? So in theory, I guess you want your equity obviously to be in excess of your debt. And as you can see that this ratio has improved. So last year their debt was 618 to only 101 of their equity. And then this year we see a big change where debt stayed similar to some extent, but equity has increased substantially. So that ratio is improving. And again, that ratio will differ depending on the company and depending on the credit that you're dealing with and how comfortable they are with certain ratios. Companies that are considered more risk or companies that are having a hard time making money may have tighter covenants, and ratio calculations that the bank are looking for versus companies that have, a long history of successful, operations and profits. They may have longer and bigger financial ratio covenants that the banks are willing to accept. Just a bigger range.
Hey, Kambez, before we move on from the balance sheet, there are a couple of questions coming in. So one of them, going back to goodwill, are there any other situations where goodwill comes up, or is it specifically in that acquisition when you're buying new business?
Acquisition is probably the most common one where I would probably see it come up during my practice. With that being said, again, it's not a robust list. There might be instances where something else has come up where you are acquiring goodwill. For the most part, I would say that's probably where it's coming from. Because if you're buying assets directly, if you're not buying shares of a company, but rather just the assets alone, you have a pretty good idea what the value is, and there would probably not be goodwill component involved. So really, it's just the business acquisitions where the goodwill would come in.
Okay. And then, on that shareholders equity line items, there's a couple on there that aren't really clear to me what it means, or they seem a little bit maybe unique, like exchange rights or non-controlling interest. What are those referring to? Do you know?
Yeah, for sure. Let me just tackle shareholder equity. So there is
All
actually
right, sure.
a
Let's do
separate,
it.
there's a separate statement that we're going to see, and it's changes in shareholder equity, and will provide us more detail as to what's actually making up these numbers. But seeing a large increase in common shares tells us that the treasury probably issued a ton of shares for cash, and that's how the company was able to generate a lot of the cash that they've utilized in the year, to pay down debt and to increase their cash account. Contributed surplus probably relates to share-based compensation. So anytime they've paid their employees in shares rather than physical cash, that is where the contributed surplus number would go. Exchange rates was a bit unique to this organization, and I actually had to look it up in the statement. And when we get to the statement, I can actually show you what that is. Foreign exchange ties back to what we talked about, where the company is reporting in Canadian dollar, but it's actually operating in North America and in Europe. So there isn't a foreign exchange component that kind of falls out from the consolidation. Deficit is basically the ending retained earnings after net income and last year's retained earnings that has been accumulated over time. And again, I'll kind of go into a bit more detail when we get to that statement. And then the last item you touched on or asked about is the non-controlling interest. So the companies that got consolidated into this statement, they may not necessarily been 100% owned by this company, by Converge. In that case, there might be, let's say, 10%, 15% that's not owned by Converge. That belongs to other investors. That component belongs to other investors. So what this line tries to do is it tries to actually carve out the component of equity that does not belong to the investors of Converge, because Converge would not have the right to 100% of the assets and 100% of the income of some of these subsidiaries. And that's where the non-controlling interest part comes in. And it just basically says that from the $648,000 that you're seeing in equity, $35,000 is actually not part of the parent company, but rather only 613 is. Hope that answered that question.
Yeah. Okay. Awesome. Thanks, Kambez.
For sure.
There are a couple of specific questions coming in here, which maybe I'll ask you, do you want to try and answer these now or do you want to keep going? So I don't know, how would you treat a deferred salary for the founder? That actually does kind of come up frequently in a startup where they're deferring their own income. Is that something that you would put on the balance sheet or in the financial statement somewhere if there's deferred income or deferred salary? This entrepreneur hasn't taken a salary?
Yeah, I guess it depends. So typically we see a couple of ways that money is actually being withdrawn from a company, and that would be salary or a dividend. When it comes to salary, if you're recording a payable, you actually do have to settle that payable within 180 days, or you're not allowed to deduct it on your financial statement. So you can't just record a bunch of salary that's owed to you and just carry it forward for a number of years. So when it comes to salary, you do have to settle that particular debt. The common deferral that we see is, the owner may just take their traditional salary, it'd be a fixed amount every month. But then if they want to take out excess money, they will actually issue themselves a dividend from the organization. Now, that's where the deferral comes in, is that dividend may not necessarily be withdrawn in cash. The shareholder may record a dividend, get taxed on that dividend that year, but cash was never actually paid out of the company, but rather it's sitting as an IOU from the company to the shareholder. And that particular line is called a shareholder loan. So that is basically money that the shareholder has loaned to the company because they have not actually physically taken that cash out. We see that more commonly, I think, in private companies as opposed to publicly traded companies, because publicly traded companies have obviously a large number of investors. And if they do declare a dividend, they will settle that dividend with cash. Whereas in a private enterprise, you may see a dividend being recorded, but not actually paid in cash. So you have the shareholder loan outstanding. And in the roundabout way, that is the deferral of the actual owner not taking cash out from the company.
Okay.
What is that? Was there another question?
Well, there's a couple other questions, but let's get through the rest of the documents here, because I think it's really interesting, and then we'll try and get to the questions at the end. How's that sound, Kambez?
Sure, let's do that. Okay, so let me kind of hop into.
We got about 10 minutes left.
Okay, yeah, so I'll try and fast forward then a little bit. So this is the statement of shareholder equity. Here's kind of the detailed breakdown of what happened in that equity section that we talked about. So we see this share-based compensation that's being issued. Here we actually see the shares issued from the treasury for public offering. So they actually got out 65 million shares for 483,000. That would be the dollar amount. That is actually the quantity. So that is a big cash injection that came into the business that they would have actually used to facilitate their operations. And then the question that was asked about exercises of exchange rights. So we see about a $4,000 balance on 5 million of shares. These are actually broken down further in these footnotes. And what happened with these exchange rights is, I think as part of the business acquisition of certain companies that they acquired, they were able to, so the acquirees were able to flip their particular shares for the shares of Converge, the parent company. And that's how that particular transaction is being reflected on the statement of equity. And it goes into a bit more detail of the three that happened during the year. So that is a bit of a unique, call it financial instrument that happened with this particular acquisition, because in theory, any business that you acquire, you can structure the business deal any way you want. There's one other thing that was actually noted in the footnotes was an earnout that happened with one of the businesses that was acquired. And yeah, I can kind of skip that part for now, just to focus on this.
Okay.
Okay, so kind of looking at the income statement. So the main lines I think that we're more familiar with would be revenues, right? So we can see that it actually was a huge hike in revenue increase. So from 948 to about 1.5 million. So that rise is about 61% growth that the company experienced during a year. So as an investor, obviously you want to see the top line growing. The main other line that as an investor you want to be looking at is gross profit. So gross profit is basically revenue less direct expenses that pertain to earning that revenue. Gross profit increased from 233 to 345. So the dollar amount looks like a nice increase. However, the actual gross margin went down from last year was about 25% to this year to about 23%. So what that tells us that although revenue increased, we did feel, call it shrinkage within the cost of sales, because the cost of whether labor or direct materials involved also went up. And it went up in a proportion that was higher to the revenue. So gross profit went down as a whole.
Well, as you're talking here, and I'm looking at it, Kambez, I do notice that the service component of the revenue looks to be a smaller component, just doing some quick math, compared to the product component in 2021. So that might be part of it. Interesting.
Exactly.
Yeah.
So that,
okay.
the
Cool.
cost related to the product probably has gone up then. Gross profit is actually one of the more important lines, I think, on the profit and loss statement, because it tells you for every, call it dollar that you've earned of revenue, you're taking about 23 cents that then you can use to pay your actual operating expenses. So selling and general administrative expenses all got lumped into one of 254. It gives you, so this statement gives you income before the following, which is $90,000. This line in a way is basically EBITDA, is kind of how they're presenting it. So EBITDA, for those that are not familiar, would be earnings before income, taxes, and amortization. And a lot of investors like that particular line because they feel like it's a normalized net income line that then they can use to put multipliers on and figure out what the value of a company is. And the reason is because amortization is somewhat subjective depending on how the company wants to amortize its assets. Interest, again, will depend on the credit facilities you have. Some companies may have better interest rates than others. And then taxes, again, fluctuate depending on if you have any losses available and how profitable your year was. So all of those items we kind of talked about are shown separately here. These are the separate components. So there was share-based compensation, depreciation, et cetera, which gave you a net income before tax of $23,000. Last year, they reported a loss. So comparing the two numbers as an investor, I obviously want to see a solid bottom line. And I want that line to be growing year over year. Seeing a negative line is probably not ideal. And then this particular line of net income after taxes gives me an actual net income or loss in the year, which then in theory is the earnings that every investor has acquired. Now, this 16,000 then gets allocated based on the number of total shares outstanding. So it will tell me that my particular earnings from this particular year is only 9 cents based on one share that I own. So if I have, 1 million shares, I would take this number multiplied by 1 million to get to that amount. The statement then goes into more detail to tell me that the diluted number is actually 0.08. The diluted being, there's a number of financial instruments still outstanding, and if all of them got converted to common shares, my earnings may actually become more diluted, even so after the fact. Any questions on the income statement? I know I just kind of fired through it because we're running out of time here.
Well, I was kind of curious if that 8 cents per share, like, what do you make of the 8 cents per share? Like, how does that compare to what you might expect for a company like this?
Yeah, so that's a good question. It's tough. So you would have to compare it to its peers, and again, compare it to the relative life cycle of this company. Given that I think last year this company reported earnings per share in a negative, tells me that any investor that's putting money into this company is really banking on the future growth of this organization. This is a growing company. This isn't a company that's going to give you returns right away, but rather you have to put the money in, wait a long time, and see then money be paid back out.
Right.
So
still has some of the characteristics of a startup there. You're kind of investing in the future potential. Yeah.
Exactly. Yeah. So your earnings, what's nice is it's a positive number. What's nice is that it's growing. And then next year, I would want to see this number go even higher, ideally, right? And then if that number goes down, it could be A, because net income went down, or because they've issued just a ton of shares and just really diluted my position. So, okay, the last statement, and equally important, is the statement of cash flow. So I think what a lot of people misconstrued is that net income or profit and loss statement is not actually a statement of cash. Just because you have a positive net income balance or a negative does not mean you have positive cash or negative cash. So the actual cash is shown on the statement of cash flow. And here what we can see is that they started with net income and started then normalizing for all the items that are actually not cash. So they took non-cash items out. And then the other thing is they made changes for the working capital. So working capital, if it goes up and down depending on the asset or liability, tells you whether there was a cash inflow or cash outflow in that particular statement. This statement is broken down into 3 sections. You got the operating activities, investing, and financing. Operating activities is a really good number because it tells you that this year the company was able to generate $87,000 just from their operations alone. So the business as a whole, without any outsiders' involvement, just the traditional selling and buying, less expenses, was able to generate a positive cash flow. So that is a really good number, and we want to see that number grow as an investor. It becomes concerning if that number is negative. That means the company is not able to facilitate its own operations to generate positive cash flow. So then that means it relies on outside cash in order to continue going. The second component is investing activities. So here would be, what is the cash that the company has put back into its own operations in order to sustain its future growth? Like we talked about, the actual CapEx is pretty small because they don't rely on CapEx. So they spend about $6,000 there. They have some contingent considerations, some deferred consideration. And here's the big line item, is business combinations of $260,000. So they spent a lot of money this year acquiring other businesses because they feel like that is the key to their success and overall growth. So their investing activities actually burned through $277,000 worth of cash, even though they only generated 87. So right now we see a net deficit between the two. They've invested more than they were able to generate. The third section is probably going to complete the picture because, as you can see, they've generated positive cash flow here. So they obviously use this cash in order to facilitate their investing activities. Majority of the cash comes from, again, that line item that we talked about, where they issued a bunch of common shares and warrants, brought in a bunch of outside investors, diluted everybody's position, I guess, and were able to put in about $493,000 back into the business. They took that cash, they put it in investing activities. They obviously repaid down some borrowings of 135. And overall, they had a positive 371 still left over after just the financing activities alone. So the net change in cash this year was actually 180,000. So their opening cash was 64 plus the 180 net that they've recovered this year got them to that 248 that we saw on the balance sheet, and that we speculated was a result of a good year, which in theory was due to the good year, but also because of the financing activities that they undertook this year to ramp up a lot of cash into their business.
So yeah, I mean, that's an interesting situation as well, where, what's your reaction to this, where the company is kind of sustaining operations through financing activities rather than through operating activities in terms of the cash required for all of their investments in?
Yeah, it's surprisingly very common. Outside of blue chip stocks that generate a ton of cash on their own, most companies will rely on outside investing or financing activities to have the extra cash that they can go ahead and reinvest in the company. Another way to look at it is if they only relied on their operating cash without bringing in these outside cash inflows, they may not have the ability to then go ahead and acquire a bunch of businesses, right? Because their growth would then in theory be sort of stumped. But as you can tell, due to this large acquisition, this company is fairly aggressive and it's thinking about growing quickly and growing now because it wants to take advantage of the consolidation and perhaps the synergy that it can get from these new subsidiaries that are being added in.
Okay, listen, Kambez, a bunch of people have to jump off. We're losing people quickly here. We're 2 minutes over time. Everybody's got tight schedules. No, people don't have an extra 5 minutes for accounting, apparently. I'm surprised. But listen, this has been a really awesome session, Kambez. I think the last question I had is, what's the best way for people to connect with you if they want to learn more about you and KRP and maybe questions they have about financial statements?
Certainly, yeah. You can email me directly or give me a phone call. I can share my information with you, Zach, and you can share it with your members later on. We're Kingston Ross Fasnax. So you can Google us, and we're a firm of almost 200 people now. A lot of very smart professionals. So really, anyone here can help you with any needs that you have.
Awesome. Thanks so much, Kambez. I think we'll probably end it here. People are jumping off. This has been a great session. Really appreciate it. And have a great afternoon, everyone. I'll just make one final plug for our investment summit coming up November 17th. Please join us for that. You can register today, and have a great rest of your week, everybody.